The end of the year is approaching fast, and right now is the perfect moment to set yourself up for success heading into the new year. So in today's video, I'm breaking down 9 financial moves you should make before the year ends. These steps will help you take control of your finances and start the new year with serious momentum. 1. Review your cash position. Year-end is the ideal time to reassess how much liquid cash you have. This includes checking accounts, money market funds, high-yield savings, or even the cash you literally keep under your mattress. When I say liquid, I mean assets that can be turned into cash within 1 to 3 business days. Next, look at what percentage of your overall portfolio is in cash. Too much cash can slow your growth. Too little can leave you vulnerable. Your optimal cash balance equals emergency fund requirement plus short-term savings goals. For example, if your 6-month emergency fund is $25,000 and you're saving $20,000 for a down payment, your correct cash target is around $45,000. One of the most practical things you can do today is calculate your true emergency fund needs and place those funds into dedicated bank accounts. By the time the year ends, you should have a crystal clear picture of your liquid assets heading into the new year. 2. Claim every dollar of free money. At work before December 31st, make sure you're claiming every dollar of employer-provided benefits. You already know the importance of a 401k employer match, but this is something you must complete before the calendar year ends. You don't need to max out your 401k. Many people can't or prefer not to, but missing out on the match means literally walking away from free money. For example, if you make $100,000 and your employer matches 4%, that's $4,000 of completely free contributions. Shockingly, about 1/3 of employees don't take full advantage of this. If your employer doesn't offer a match, check if they offer an employee stock purchase plan, (SPP). Some companies allow you to buy their stock at a 15% discount or more, another form of free money, if you believe in the company's long-term outlook. 3. Calculate your total liabilities, and then your net worth. Take inventory of all your debts. Car loans, credit card balances, personal loans, student loans, everything. Sort them by interest rate. High-interest debts should be your first target heading into the new year. After that, list out all your assets, bank accounts, brokerage accounts, 401k, Roth IRA, your home, car, or even equity in a business you partially own. Now subtract liabilities from assets. That number is your net worth. As investments grow as a percentage of your wealth, your net worth will naturally fluctuate more, sometimes wildly. Choose a tracking frequency that works for your mental health. Monthly, quarterly, whatever you prefer. The key is consistency. 4. Review the big 3 expenses. Housing, transportation, and food. These 3 categories typically account for 60% to 70% of most people's budgets. If you want to increase savings or investments, start here before cutting small expenses. For example, if you pay $3,000 per month for rent in a high-cost city, but can find a comparable $2,000 apartment just 20 minutes away, you immediately save $12,000 per year. It's not about being cheap, it's about being intentional with the biggest parts of your budget. By December, evaluate whether any of these categories can be optimized for next year. 5. Consider tax loss harvesting. Tax loss harvesting lets you sell investments at a loss to offset realized capital gains for the year. Example, you bought Alaska Airlines stock earlier this year and are down $5,000. You also realized a $7,000 gain from selling AMD. If you do nothing, you owe taxes on the full $7,000. But if you sell Alaska Airlines and recognize the $5,000 loss, your taxable gain drops to $2,000. Just remember the wash sale rule. You cannot buy back the same stock within 30 days if you want to claim the loss. Large losses can be carried forward for future years, but note, only $3,000 per year can be used to offset ordinary income. 6. Renegotiate bills and insurance policies before the year ends. Call your insurance providers, auto, home, health, to compare pricing or negotiate better rates. Also call your credit card issuer. You may be able to reduce your interest rate or access promotional offers that save you money. Even saving $100 a month from a few phone calls is absolutely worth it. 7. Max out tax-free accounts. Roth IRA and HSA. Your HSA, health savings account, is the most tax-efficient vehicle available. Contributions are tax-deductible. Growth is tax-free. Withdrawals for qualified medical expenses are tax-free. Just make sure the funds inside your HSA are actually invested. Too many people forget to do this. Contribution limits change annually, but are around $4,300 for individuals and $8,750 for families. For the Roth IRA, contributions grow tax-free. Limits are around $7,000 under age 50 or $8,000 over 50. If your income exceeds Roth IRA limits, you can use the backdoor Roth strategy. Contribute to a traditional IRA and then convert it. Just be mindful of the pro rata rule if your traditional IRA contains both pre-tax and after-tax funds. 8. Calculate your savings rate. Your savings rate is one of the most fundamental numbers in your financial life. Calculate your average monthly income minus your average monthly spending over the last 3 months, and that difference is your savings amount. Then divide by income to get your savings percentage. On this channel, we target a 15% to 20% savings rate, including 401k, IRA, SBB, and brokerage contributions. 9. Set your financial goals for 2026. Pick 1 or 2 goals, not 10. People who set too many goals rarely hit any of them. Examples: max out your 401k, build your emergency fund, start your Roth IRA, open a 529 plan for your kids, pay down credit card debt, increase your investment contributions, check in with a financial advisor, pay off your car or mortgage. Choose the goals that matter most to you, then build your plans around those. And in the comments, I want to hear your goals, your savings rate, your net worth target, whatever you feel comfortable sharing.